You don't own the house you live in. The bank does. But in 2008, the banks didn't own themselves either. They were borrowed against borrowed money, stacked on assets that only had value as long as everyone agreed not to look too closely. The entire edifice was a confidence trick, and confidence, once lost, does not return with a phone call. Welcome to Money Documentary, where money, power, and history collide, and nothing is ever as simple as it looks. The years leading up to 2008 were a fever dream of cheap credit and rising home prices. Lenders handed out mortgages to anyone with a pulse, rating agencies stamped AAA on piles of subprime debt, and Wall Street turned those debts into securities that were traded like baseball cards. The entire system was built on the assumption that housing prices would rise forever. They didn't. Lehman Brothers was not a bank, not in the way you imagine a bank. It was a node in a global web of promises, a firm that had spent 158 years evolving from a dry goods store in Montgomery, Alabama, into the fourth-largest investment bank in the United States. It had survived the Civil War, 2 world wars, the Great Depression, transforming from a cotton brokerage into a derivatives powerhouse. At its peak, it held over $600 billion in assets, but those assets were built on a foundation of borrowed money and wishful thinking. Somewhere along that arc, it forgot that leverage is a multiplier of both gains and losses. By 2008, its entire balance sheet had become an optical illusion, a machine for hiding risk that would, within months, freeze the global financial system. The uncomfortable truth is that Lehman didn't fail because of bad mortgages. It failed because the entire system had become a machine for hiding risk. Mortgage-backed securities, collateralized debt obligations, repurchase agreements. These were not just financial products. They were alibis, ways to make leverage look like prudence, to make a 30-to-1 debt ratio appear as manageable as a mortgage on a suburban home. The firm had become a warehouse for the risk no one else wanted. They sold off the safe mortgages and kept the toxic ones, convinced that housing prices would rise forever. That was not a strategy. That was a death wish written in spreadsheet cells. We talk about the housing bubble as if it were a weather event. It was not. It was constructed. Built by lenders who handed out loans to anyone with a pulse, by rating agencies that stamped AAA on piles of subprime debt, by regulators who believed that markets self-correct. And at the center of it, Lehman Brothers had become the ultimate repository of that construction. The uncomfortable implication is that Lehman's collapse was not a surprise. By early 2008, the firm had posted its first quarterly loss in 14 years. Its stock was in freefall. The market knew something was wrong. But the real danger was hidden in the mechanics of its funding. Lehman didn't borrow the way a traditional bank borrows. It relied on repurchase agreements, overnight loans secured by assets. Every morning, it had to find someone willing to lend it billions of dollars against collateral that was losing value by the hour. This was not banking. This was juggling chainsaws on a tightrope while someone set fire to the rope. The repo market was the plumbing of Wall Street, and Lehman had become its most leaky pipe. The firm used what regulators later called window dressing, temporarily reducing its reported leverage at the end of each quarter to hide the true scale of its borrowing. It was a quarterly ritual. Sell assets just before reporting, then buy them back after. A sleight of hand that made the debt-to-equity ratio look almost respectable. When confidence evaporated, the makeup washed off, and the patient was already dead. Debt is gravity. You don't feel it until you stop moving. And in September 2008, Lehman stopped moving. The uncomfortable question is, why did no one catch it? In the final days, Dick Fuld, the man they called the gorilla, scrambled to find a buyer. Barclays wanted the healthy parts but not the toxic waste. Bank of America walked away. The Federal Reserve and Treasury drew a line. No bailout. The moral hazard of saving Bear Stearns was still fresh. Letting Lehman fall was supposed to teach a lesson. It taught a lesson, but not the one they intended. The fall triggered a global panic because Lehman was not an isolated island. It was connected to hedge funds, insurers, money market funds, pension schemes. 0 employees lost their jobs, but the real damage was to the invisible circuitry of global finance. Replace dynasties with institutions. Replace courtiers with bureaucracies. Replace caravans with supply chains. The logic remains. A single node fails and the entire network seizes. That's what happened on September 15, 2008. The largest bankruptcy in American history, $639 billion in assets, $613 billion in debts, just wipe out shareholders. It froze the credit markets that ordinary businesses rely on to make payroll, that homeowners rely on to refinance, that students rely on to pay tuition. The stock market suffered its greatest single-day loss ever on September 29. The global economy lost an estimated $10 trillion in output. These are not numbers. They are postponed retirements, foreclosed homes, dissolved savings. Discipline turned into comfort. Comfort turned into decadence. Decadence turned into decline. Lehman had survived the Civil War, 2 world wars, the Great Depression. It had transformed from a cotton brokerage into a derivatives powerhouse. But somewhere along the way, it forgot that leverage is a multiplier of both gains and losses. Its executives, Dick Fuld, the man they called the gorilla, had turned risk-taking into a culture. And culture, when it curdles, becomes dogma. Dogma that housing prices only go up. Dogma that repurchase agreements are as good as deposits. Dogma that complexity equals safety. One detail often forgotten. Lehman's collapse nearly broke the money market fund industry. The reserve primary fund, a supposedly safe place for cash, broke the buck because it held Lehman debt. That panic forced the government to guarantee all money market funds, a backdoor bailout of the entire system. The uncomfortable truth is that the crisis was never just about one bank. It was about the illusion that risk could be sliced, diced, and sold until it disappeared. It didn't disappear. It just moved to the place no one was looking. So the question isn't whether this was fair. Systems don't care about fairness. They respond to incentives, and the incentives of modern finance reward opacity, leverage, and short-term thinking. Lehman Brothers was not a villain. It was a symptom of a system that had outsourced risk assessment to algorithms, that had allowed banks to become too big to fail yet too interconnected to save, that had mistaken liquidity for solvency. If Lehman were alive today, it would recognize the world it left behind. The Dodd-Frank Act of 2010 was the legislative response. Higher capital requirements, the Volcker rule to limit proprietary trading, and the creation of the Consumer Financial Protection Bureau. Central clearing of derivatives became mandatory, aiming to reduce the tangled web of bilateral contracts that had made Lehman's failure so contagious. But regulation is a game of cat and mouse. Banks adapt. They find new shadows. The same debates about shadow banking, repo markets, and systemic risk still echo through central bank meetings. Confidence is still oxygen, and when it's gone, you don't just struggle to breathe. You die. So what does this mean for the individual? Your pension fund held Lehman bonds. Your money market account froze because it owned Lehman commercial paper. Your employer couldn't get a short-term loan to cover inventory, so they laid off your neighbor. The collapse was not a Wall Street story. It was a Main Street story that happened to wear a suit. The public anger was not just about lost jobs. It was about the sense that the rules were different for those at the top. Executives walked away with millions, while homeowners received foreclosure notices. The Tea Party and Occupy Wall Street were born from that anger, movements that reshaped politics for a decade. When trust in the financial system breaks, the cost is not borne by the people who broke it. It is borne by people who never knew what a repurchase agreement was. That is the uncomfortable legacy of 2008. Not that banks failed, but that the failure was socialized while the profits had been private. The system didn't break. It worked exactly as designed. The design just wasn't for you. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.